This session, I think, is about the sources of alternative capital in this uncertain time. And in that context, I run a team called Asia Access, which is a whole team based out in London. And what we do, what it says on the tin, and that is we find Asian capital to a European situation. I started this team 15 years ago, and to date, we have successfully completed 136 east into west M&A transactions. So pleased to be here.
Thanks, Tosh. I'm Kira. I lead on the capital advisory team at DC. That simply means helping borrowers find solutions to their capital needs. As Tim says, one of those is distributing capital to LPs in this market.
And I'm Michael Wieczorek. I co-lead our secondary advisory solutions team, predominantly focus on GP-led solutions. We are a new alternative source of capital that is predominantly used to optimize value creation, but also, as Tim alluded to, very importantly, return liquidity to investors.
Great. So we'll just focus first on the Asian access. It's one of our key differentiators, so why wouldn't we? Tosh, so can Asian capital deliver exits and realizations for private, public, private equity-backed businesses and provide growth partners in this current geopolitical environment?
Sure. So I'll start with Japanese capital. I think it is more relevant than ever, and just the number actually shows it. So comparing 2023 to 2024, Japanese M&A market was the only M&A market in the world which has grown by 17%, when the rest of the world is obviously negative, negative, negative. Even looking at the most uncertain period of Q4 2024 to Q1 2025 we've just had, Japanese M&A had been flat when the rest of the world is up to 30% negative. In terms of Japanese acquisition into Europe, when I started in the financial services 30 years ago, there literally was not my job. I wouldn't have been able to get a job in what I do today. Since then, Japanese acquisition into Europe has grown by 145 times. And the Japanese is not just buying, they're also selling businesses. So the Japanese disposal of European-owned asset has grown by 7.5 times in the last 5 years alone. Now, why is this actually happening? And this is actually a good news to European owners of private equity sort of asset. When you're looking for private equity and also trade buyers from the West, you can now rely on the Japanese in certain sectors to come and acquire the business from you. Now, why is this all happening? It's because, yes, there is a demographic challenge in Japan of the shrinking population, and they have to look for growth overseas, so return for higher ROI, etc. But it's actually all coming from the shift in a corporate sort of culture and the selection of focus that the Japanese have started to pursue by breaking down of the conglomerate in Japan, partly aided by the Western private equity, which has now arrived in masses. Japanese are doing a lot of carve-out and selling and recycling that money into acquiring high-growth business abroad. And Europe provides a very fertile ground for things, the businesses that the Japanese like to source. Another thing that I would say is that, the proof of all of this is that the Warren Buffett has taken famously a 5% stake across all the Japanese trading houses. He's a very, very clever man. That's yielded about 14 to 17% return per year. All his investments are back. Now he owns close to 10% of the largest 5 trading houses. And by the way, later on, if you hang around into the main DC Fest, we have over 50 Japanese investors who are invited and will mingle with you, many of whom from Japanese trading houses, investing into many, many different industry sectors which are relevant to you. So they don't know that you'll be coming to ask for money, but please don't feel shy. They have a massive balance sheet and they are here to do deals.
Excellent. And what should European sellers know about how to navigate and transact with Japanese parties?
Yes, so I think those of you who have who sold the business to Japanese and dealt with Japanese in M&A context, you know that they pay up, so they can basically think very, very long term. They pursue synergies and they pay for the synergies. So they're often very, very price competitive in a process. So that's a good side of the story. The flip side of it is that their decision making is often opaque, slow. You don't know what they're thinking. Their behavior is very different in deal, and you get like 1,000 questions in due diligence, and everything takes so long. Now, what I advise my client is, therefore, you have to think slow, quick when it comes to preparing for a transaction where the Japanese might well be an eventual buyer. What I mean by that is it's all in the preparation. The Japanese are slow in aligning themselves internally, not because they think slow or not because they don't understand the Western logic. It's because they have to align a very complex internal body of decision making where you have to think about the strategic angle, the world market, the competition, and also within the large conglomerate, which often competes for budget. They have to be able to say, yes, this is a business we should be buying, and this is the best one that is available, and this is exactly how much synergy it's going to produce by bolting it onto their business. And all of that answer needs to be delivered before they come to the starting line and start dissecting the IM. So, if you basically knock on the door of a Japanese when you actually start the process, it's already lost. There's no way that they can keep up with the speed. But thinking slow, quick, the upside of it is that once the Japanese are convinced, they become a formidable, very reliable anchor in your process who can cope with a Western style sort of process speed to come to the end and often outbid the Western bidders.
Excellent. And I mean, Asia Access is beyond Japan. We've talked a lot about China, and in this environment, I mean, how do we see the Chinese as, are they credible buyers, competitors, counterparties in transactions in this environment?
So I'm gonna steer well clear of what Sir John talked about earlier, and that is that the most interesting aspect of a China into Europe M&A is a politically neutral capital. So what's happened in the last 5 years is that the Chinese have all reinvented themselves. Chinese private equity have reinvented themselves and call themselves now Asian private equity. A lot of their LPs are coming from Middle East, of course, private sector of China, and even from US and European LPs. They have a clean offshore structure, which is politically neutral, and they also like to invest into high growth, inoffensive industry, which will not be blocked by either the West or the Chinese regulatory and FDI regime. They have started hiring a lot of ex-bulge bracket and M&A battle-hardened Western bankers and started opening shops all over Europe, especially in London. And these are the people who are able to do deals in a Western manner and without without being stopped. So if you look at the statistics, last year, that 1/3 or over 1/3 of Chinese investment has gone into Europe. Since the tariff, we predict more of the Chinese investment are going to be heading to Europe. So it is your chance.
I guess Marshalls is a good example of a transaction of that nature. I mean, and underpinning all of this, so that Asian capital is real and it's there. These are things that will provide other sources of liquidity. Kira, as I think we all know, what underpins the market is debt. And how do you see the debt markets and also the debt and the credit funds in the context of providing more structured structured solutions that's bridging that equity gap?
Yeah, so what we've seen are two really interesting parallel trends. One being the top 20 global asset managers have raised record funds on their latest vintages. And we also know that those fund managers are incentivized to deploy. Just raising the capital is not going to get them paid, it's getting it deployed. Then in parallel, whilst they've been expecting healthy M&A volumes, we've seen a protracted, depressed M&A market for all the reasons that we all know. And therefore, that's making those managers think more creatively about how can they deploy in size when they've raised 10, 15, 20 billion funds to deploy. How are they going to get that money out the door? So what we've seen in especially the last 9 to 12 months, is a lot more creativity around junior capital, whether that's in the form of holdco PIK issuance, preferred equity structures. In the past, it would have been exceptional to remark on a £500 million junior issuance. Now we could point to at least a dozen of those, even in the last quarter, in the private capital world. And DC itself has done 2 in that north of 800 million in the last couple of months. Now, what I would note is, if you track all of those, they're definitely concentrated in 2 key sectors, healthcare and software. So they're happy to go very deep, but in those sectors that will show resilience through the volatility that the previous panel discussed.
And in terms of the junior market, in terms of your view today of, because as we were saying, with geopolitics, debt has changed on a daily basis. Where are we at today and the next, the next quarter from underpinning transactions from
we're still
debt?
seeing a really strong bid there. It's not just in that first lien capital, but right through to very deep junior. There is a huge pressure, I would say, to deploy capital in size, and so they're trying to be very creative and go deep.
So positive.
Positive, yes. There's definitely positive momentum to deploy more, as you can see from the stats in terms of where we are in terms of A, funds raised, and B, the limited deployment opportunities that they're getting, because it's all skewed to refinancings. They're not getting enough new issuance coming through.
Great. And look, the charts are difficult to see and read, I'm sure, but they give us a signal, but we will share these with those people who would like to afterwards. Just moving, it's a continuum, the debt equity spectrum, and it's a bridge to transactions. Michael, sort of I would call it, people talk about it as a new phenomenon. I know it's not new, but it's a growing phenomenon, the rise of the secondary market. And with traditional M&A exits having been more challenged, we can see that. And some of the headwinds. What are you seeing in the alternative solutions to deliver liquidity for GPs?
Yeah, thanks, Tim. I mean, firstly, it's definitely far wider increased acceptability of actually utilizing GP-led solutions, in particular continuation vehicles, as a flexible liquidity option in today's market for sponsors. It's nice to see, in the context of a difficult M&A market and some difficult charts since 2022, activity levels in our market, in fact, have doubled over that comparable period. When you look at comparable sponsor-backed exits, last year, about 13 to 14% of all sponsor-backed exits were driven by secondary solutions. And then when you look at the activity and the acceptance in the markets, if you pair the top 100 sponsors globally, more than 80% have completed a secondary transaction. Many have done multiple. And this activity level is also trickling down to the mid-market. When we first started the capability at DC, back in 22, 23, majority of our conversations were really around education, CVs 101. How can we potentially be accretive to sponsors when I think about generating liquidity? Today, the conversation is more about the art of the possible. I would argue that largely most sponsors actively consider alternative solutions, CVs in particular, as ways of generating liquidity. The market is more than a strategy for a fundraise. It's really an alternative or an addition to the M&A toolkit. And I think when we deliver these types of solutions, it's important to have the capability around the assets, which we regularly partner with our sector teams, and also look at the capital structures of the assets that we are bringing to new structures when we're raising additional equity, but also often debt capital alongside with our capital advisory colleagues.
making it real, what are the real benefits, not just for the sponsors, but for management teams going through this? Because it's definitely a new for management, even if it's not for the GPs who may have done one or two before.
I mean, principally for sponsors, let's start with DPI. We've seen the chart. DPI has become the new performance metric for most sponsors. It's about generating liquidity for your investors, but at the same time, staying with your winners versus selling them to your competitors and watching them benefit from your hard work in terms of the build out of the assets. It's also about finding new solutions to raise capital to fund growth initiatives. And it's about the opportunity to really have the really have the longer time to really execute on your value creation plans. For management teams, continuity is important as well. It should be also stressed the ability to raise that growth capital in an efficient structure and an efficient manner as well. Then we look at the ability for management teams to crystallize existing MIPS and also reset those MIPS to be part of that value creation story going forward. And as businesses grow, it can also create an opportunity for generating that window and that avenue for succession.
And in terms of from where we sit today, what's your perspective for the remainder of 25?
Our market has taken, I would say, a pause given the turmoil we had with the tariffs and the challenges in macro, but it was only a very brief pause. The last time we had this level of a pause was probably COVID, and I think the participants have learned that stepping into the market for an elongated period, 3, 6, or 9 months, will cause them to miss opportunities. That said, the market, when you look at the capitalization of the market, still remains relatively well capitalized. A popular or very common metric in the market is the deal flow to capital ratio. Today it stands roughly at about 1.8 times. It's at the lower end of what has been there historically. That said, when you look at those numbers, it still suggests there's about twice as many deals as there is capital to fund those transactions. Fundraising, as we both know, on the sponsor side remains challenged. However, it's a very different picture for the secondary market. Last year, the secondary market raised about 100 billion in capital. That is up 30% year on year. Put that on a relative basis, the buyout market was down 40% year on year. Then we look at the alternative sources of capital, which are not only bringing capital, but I would argue new execution capabilities. There are direct sponsors that are entering the secondary market. Why? Because they realize some of the best assets may not be available on the primary market. And they are also adding a new execution capability by having the ability to diligence more specialized sectors, more specialized geographies, and really adding, I would say, a new liquidity spectrum to the secondary market. Then the last sort of, I would say, still untapped elephant in the room that is now really growing in terms of democratization of private equity is the retail channel. If you look at the 40 Act funds, which again is a retail product in the US market, over the last 18 months, that has brought in an additional 70 billion of capital. These are structures that are required to deploy quickly. Secondary transactions provide a highly funded opportunity to get that capital in the ground and really have formed a mainstay of 40 Act funds. And lastly, when we think about what sectors still resonate in today's markets, for our large accounts, secondary investors are sector agnostic, which simply means they don't need to do a consumer deal, they don't need to do an industrial deal. They focus on resilience, they focus on high margin businesses, and they have the ability to tilt and move from sectors to make sure that they are deploying in terms of the best ideas and the best sources of return for their own investors. So today I would say when you look at the broad sectors in terms of what's getting executed and done, I would largely characterize them as businesses that are relatively institutionalized, probably have an LTM EBITDA that's in the double digits. And in terms of sectors, it tends to be largely business services, TMT, and healthcare.
Okay, so I mean that's interesting perspectives on this is what was potentially called a different source of capital to the traditional M&A GP private equity. It's on the rise. Just interesting questions from the audience around, well, A, has anybody had an exit to a CV vehicle in the room? That would be a... So anybody had a CV in their portfolio? Well done. That's one. So that's actually. So this what we're talking about is a new phenomenon. It's relatively new, but it's coming. It's going to be more prevalent. Is that would be the message. Opportunity for questions from the floor.
When you were talking about that retail market, and you sort of mentioned, did you say $70 billion?
Correct.
And is that all in the US right now? And what are you seeing in Europe in terms of that retail market and how it's evolving?
Yeah, it's not as big as the U.S. market, because the U.S. market, of course, when you look at the quantum of private savings that are institutionalized and managed, it's a much larger quantum. It is slowly starting to open up here in the UK. We've seen different structures in France as well. It is moving, but it's not as quick in terms of the same sort of velocity as we see in the US market. But if you look at the main proponents of these retail products, it tends to be the more specialized, I would say, traditional secondary investors, so either secondary funds or fund of funds that have secondary capabilities. Today, it's primarily used as a overflow vehicle for a lot of these investors, i.e. when they make a commitment and they underwrite a deal in their traditional program, they will often co-invest alongside these retail products as well. But as they scale, they will be able to also, I would argue, lead a number of these transactions themselves as well.
I mean, just on that retail theme, you talk about the US, Europe. I mean, Daiwa in Japan raised a retail fund for one of the, we can't name the name, a very large US asset manager, not white, and has it's a hard object. Is the second part of the name, but we can't name it. Hiroki.
We can name 1.5 billion was raised for half credit fund and then half LBO fund.
And that dynamic of, we talk about the UK trying to get more private capital deployed from the pension funds, etc. The driver for private retail and private capital coming into the market will be a new and hopefully positive dynamic. We'd like to be at the forefront of that. Are there any further questions, or should we wrap this up?
I was just going to ask one follow-up question on that thing. Do those retail investors expect the same returns as traditional LPs, or are they anticipating a lower return?
The underwriting is the same, perhaps the fee model is slightly different.
Okay, great. Well, thank you for your insight. It's much appreciated.